From the audio that moves you to the audio that gets you moving. Soundtrack your every movement with the free TuneIn app. Available on your phone or tablet. Download TuneIn on the App Store today.
Not all heroes wear capes, but most wear tights.
And here we go. Now it's underway. Cover on Rowan. 20 seconds.
Keep up with everything happening in the wild world of pro wrestling with the TuneIn podcast. For expert analysis of the latest WrestleMania, turn on the WWE podcast. Or listen to the Steve Austin Show for no-holds-barred conversations with wrestling's biggest personalities.
It's good to be here tonight. It's an empty building.
For these and more, search sports and scroll down to the world of wrestling.
Impulse and your actions.
This is Chime, a mobile bank account and debit card with no hidden fees, no overdraft or monthly maintenance fees. And I can even get my paycheck up to 2 days early with direct deposit.
Start banking with Chime today at Chime.com.
You went to college? You're smart. So why are you getting ripped off on your student loans? At Credible.com, we've helped tens of thousands of people save money by refinancing their student loans. In 3 minutes, we'll get you actual rates from multiple lenders. We could save you hundreds of dollars a month by refinancing to a lower rate. Don't get ripped off on your student loans. Let's focus on your future, not your debt.
Visit Credible.com and in 3 minutes, see how much you could save.
Hi, I'm Hanno. I created Gabi because most people overpay on car insurance. Gabi is a free tool that saves you money by finding the best deal. Gabi users save more than $800 per year on average. Go to Gabi.com and stop overpaying for car insurance.
We are going to take a quick break, but before we do that, take a look at the biggest laggards on the Dow for the week so far. Boeing, Raytheon, American Express, Walgreens among them. We're going to be right back. Stay with us.
It's TuneIn Sports on this day, March 27th, 1988. The Chicago Bulls and Atlanta Hawks match up in the Georgia Dome in Atlanta. Now, it draws a crowd of 62,046, the largest in any game in the NBA history. And the Bulls win 89-74.
Well, there's no question the spotlight today will focus on Dominique. Given what happened last week, I would think there's some incentive for Dominique
to listen to conversations breaking down the moments just like this. Click on Sports to be part of the discussion on TuneIn.
Did you know TuneIn doesn't just live here on your smart speaker? From the audio that moves you to the audio that gets you moving. Soundtrack your every movement with the free TuneIn app. Available on your phone or tablet. Download TuneIn from the App Store today.
Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow at TuneIn and always be in the know.
Behind the highlight reels, championship rings, and colossal paychecks, there are sports stories that fuel, deepen, and even challenge our love for the game. For true tales of underdogs, anti-heroes, and game-changing innovators, search sports documentaries on the TuneIn app.
A lot of people aren't aware that TuneIn lets you listen to the same terrestrial stations that you pick up on your FM AM dial, except you can hear them from anywhere. To see all the stations broadcasting in your area, find the local radio section on the home screen. Keep it local with TuneIn.
PD. A curved direction with a bump that bothers you is not normal and should be checked out by a urologist. Because you don't have to accept this as your new normal. Find a urologist at learnaboutpd.com.
We cannot do all the good that the world needs. But right now, the world needs all the good that we can do. To everyone working to keep America strong, thank you.
New York City's a travesty. The mayor waited way too long to impose the lockdown. Now we're all paying for it. So I think a nationwide shelter-in-place order would make a huge difference in the course of this pandemic. Watch or listen live on the CNBC app.
Aviation and transportation company Blade is using its resources to help with the movement of medical supplies and even organs around New York City to hospitals like NYU Langone and Mount Sinai. Joining us this morning is the CEO of Blade, Rob Wiesenthal. Rob, it's great to have you as always. Thanks for coming on today.
Thank you.
A lot of startups are going into hibernation in this period, and understandably so. You've chosen a different path. Can you talk about what you're doing specifically around the city and why this was better than shutting down, essentially?
Sure. I think myself, along with the rest of the team, appreciates what New York has done for us. The city's been great to us. I was born and raised in the city. And right now, there's obviously very little non-essential travel. So we quickly decided that the right thing to do was to not wait it out. We deploy our workforce and leverage our core competencies, which are mobility and logistics, to help with the relief effort. So we're focusing on three things. Number one, our mobility program, which, as you mentioned, will start with Langone. Now more than ever, with the hospitals stressed, we are doing a lot of the logistics and helping Langone move organs for transplant patients. And we're also even flying patients for clinical trials. And we're working with the leadership efforts of government agents who are part of the relief efforts to make sure that hospitals can get what they want when they need it. We also have a fly home program where we're repatriating citizens who are still stuck overseas. We recently did a mission from Morocco where we worked with the State Department to repatriate 27 senior citizens. Beyond that, that was actually deemed a humanitarian effort, and the aircraft was a 737 donated by Rob Goldstein, the CEO of Las Vegas Sands. So we're very happy about that. Today, we also launched for our hospital partners, actually about a week ago, essential ground transport that's safe for doctors and equipment. So you can have actually a safe ride that has uniformity, unlike potentially ride-sharing services where drivers are actually temperature checked. We use electrostatic decontamination. And today that's actually open to individuals to book for essential travel only. And all the proceeds go back to fund more trips for doctors and hospitals.
Huh. How long can this go on? I mean, obviously the need is going to be there for an extended period of time, maybe even once travel demand starts to recover. What's your timeline on that?
Well, I think that, look, we have two things going on. I think if you looked at the graphs that the president showed a couple days ago, clearly New York and New Jersey, the tri-state area, are clearly ground zero for the epidemic. So, we're counting on that, for all of April, clearly we'll be under lockdown, and there's a very good chance that in May it will continue. So we're preparing for that potentiality. If so, we'll continue working with our medical partners and providing safe trips for people in New York City who have essential travel, because despite the fact that we are under lockdown, there are people that need to see doctors. There are people that need to go places that are not within walking distance. Drivers need to be safe, and passengers need to be safe. So we'll do this as long as we need to. We're well capitalized, and we're obviously hoping that this resolves itself and people can kind of get back to work once it's safe. We're relying on the experts to tell us when that is. The virus is going to tell us when to get back to work, not anybody else. So we'll be closely monitoring, and hopefully by this June, things will start get back to normal.
Rob, you said you're well capitalized, and that's clearly an important point. Kudos to you for doing this during this period. I wonder, are you able to get cash flow from this? Does this help your position as far as staying in business for when we eventually get out of this, or no?
No, it does not. This clearly is, we had two choices. You can lay off and furlough employees and hibernate. We don't think in the long term. We've been around for 6 years. We hope to be around for a very long time. That's not the right way to run a business. New York City needs us now. The hospital needs us. The hospital system needs us now, and they've been very good to us. So now's our time to focus on these relief efforts. Hopefully, we won't have to be doing it for much longer, but we're here for the long term. And then I think once we get back into a more normal mode, I think that our flyers, our customers, and our partners will appreciate our contribution during this time.
Yeah, absolutely. I mean, and perhaps there's never been a greater need for rapid transportation than in the midst of this health crisis right now. I just want to go back to your expectations for return to ridership post-outbreak and how quickly you think that will actually ramp back up. And we've had a number of CEOs tied to aerospace on our air, even just this morning, who suggested that they think it's actually going to take a while.
It is going to take a while, but I think that our business has been definitely focused in the past very much on a higher end audience in terms of income. A lot of business travel. I think that it's going to take some time. Clearly, our airport business is going to suffer. It's going to take a long time for the right now TSA passengers are down 95%. However, I think movement to leisure markets over the summer at some point will pick up. Hopefully June. You're going to see a lot of travel stop overseas. I really believe that people are going to be spending time closer to home. And what we're very much focused on in urban mobility is short distance aviation. So I think that hopefully when this returns, we believe that our flyers will be one of the first back into the air.
Rob, we really appreciate that, and obviously a lot of people rooting for you and the efforts you're doing for the city and the hospitals. Hopefully we'll talk soon under some different circumstances. Thanks.
I look forward to it. Thanks, Carl.
Rob Wiesenthal of Blade. Guys, Mnuchin on Twitter with an update on the loan program. As he says, $875 million processed, almost all from community banks. Big banks taking applications and will be submitting them shortly. We're going to look for metrics like this, given all of the reports of confusion, guidelines that are unclear, qualifications you need to have with the banks, being customers, what kinds of customers. So that's going to be very key.
Yeah, Carl, our own Hugh Sun of CNBC.com tweeting just in the past few minutes, this is a chaotic mess of mega banks. Only Bank of America is live right now for a subset of customers. He goes on to mention Wells Fargo saying straight up no applications today.
Yeah, with a number of small business owners in my family, my husband, parents, some other folks, definitely been a lot of confusion, definitely a lot of focus on trying to get those applications in today. Also, what it's going to mean in terms of keeping people on the payrolls in the near term when there isn't necessarily, depending on your business, work to be done and how that plays out versus those jobless claims that continue to climb and climb.
Yeah, and of course it's all about payroll, but there's the added question about your utility bill and your lease financing and your inventories, all the working capital. How do those needs get answered as well? Guys, everybody have a good weekend. We're going to get back here on Monday. For now, let's get to the judge.
Thank you, Carl. Appreciate it very much. I'm Scott Wapner. Our breaking news continues now. It's good to have all of you with us yet again on this Friday on Halftime, the end of another volatile week on Wall Street, culminating with that very difficult employment report. We're keeping our eyes on all of the major developments this hour as we attempt to chart the way forward for your money. We'll do that again today with the Investment Committee. They're here. Josh Brown, Steve Weiss, Jim Leventhal, Shannon Sakosha is the Chief Investment Officer at Boston Private Wealth. Let's go right and check the markets where we are right now. Dow has a loss of more than 300 points, just about 1.5% for pretty much everything. NASDAQ not quite as bad. Russell is down sharper than the others. You see the Russell there is down about 3%, really taking it on the chin this week. Is the Russell, the major averages, heading for a down week after last week's big snapback, and that's kind of where it leaves us. So, Steve Weiss, I think it's constructive on a Friday, and maybe we should make it a consistent thing at this point, given what's going on in the markets, to just take stock of where you think we are today and how we should look forward to the week ahead.
So Friday has been a risk-off day. It doesn't look like today is any different than others. And I think actually the market's trading on a fairly sane rhythm today, given the jobs report, which even though it was above consensus in terms of bad report, nobody had a firm number. They expected it to be bad. From my standpoint, what I'd like to see is I'd like to see corporate America, particularly the well-funded public companies, take a quarter off of worrying about profitability. As a shareholder of public companies, I'd support that. Most important right now is to worry about employees and the communities in line with the Business Roundtable statement that they put out on August 19th of last year. So I think that would give everybody comfort, because the number one thing we got to worry about is the economy.
You're talking
and that will help the economy, help the consumer come back.
You're talking about big companies coming out like, Brian Moynihan said earlier, even as it relates to just kids who are coming out of school, that they're going to have jobs, not to mention the current employees of Bank of America and some of these other firms that are keeping their employees. As we've been talking the whole time, and Cramer has really, I think, led the charge in this, hashtag no more layoffs. That's what you're talking about.
Exactly. Exactly, and you know what? Larry Fink has put out a number of letters. They redefined what the corporate purpose is, and they put shareholders last. They put employees, communities ahead of shareholders. That was the right thing to do. As owners of more than 50% of every publicly traded companies, the passive firms, BlackRock and Vanguard leading it, should come out and say to companies, we want you to worry about those higher up in the food chain, your employees, your suppliers, your communities. Take care of them first. We think long term. We think 10 years. 2 quarters of foregoing profitability, take care of those people, isn't going to matter. That's what I would like to see. And I think the market would trade up at that point.
Yeah. So, Shannon, tell me where you think we are in the market at the current time. Again, coming off of a week that was huge to the upside. Now we're going to likely end to the downside this week, and we try and figure out where we go from here.
The challenge here is that we've seen the positive impacts of the Fed already, and we're looking for that positive economic stimulus. I see a lot of historical work being done over the course of the last several weeks, looking at, when the markets bottomed versus, peak jobless claims or the lowest levels of the ISM. I think the challenge here is if you're looking for economic data to provide you with this path, we've seen such a rapid deceleration in economic data. I don't know that it's an apples-to-apples comparison. So we're really looking at those parts of the market that have caused, I think, some of the dislocating impacts. So, for instance, when we saw the VIX spike, a lot of that was based on the fact that we saw those sharp declines in energy. We saw a lot of margin calls. We saw some short covering. So I think we're moving into perhaps a still elevated volatility period as represented by the VIX, But I think that what we're looking for now is that it's going to be more looking at the underlying companies, looking at asset classes, looking for reallocation, and potentially not calling a bottom here, but the ability to put some capital back to work for longer-term investors. I think equities look attractive, and I think we need to be more comfortable that this is probably a 2-quarter economic impact, and therefore, we can start to model that out and price that out as we get this economic data.
So, Josh, the other side of that is what Morgan Stanley talks about today when they talk about deeper drop, slower climb. We're talking as if, and Shannon just mentioned, at least in her eyes, this is a 2-quarter situation. What if it's not? What does that mean for the stock market?
Yeah, it's not a 2-quarter situation. So I'd love to be wrong about this. I don't think I will be. And I think what Morgan Stanley had to say is reasonable. One of the most important roles that a money manager plays in the lives of their clients is not just what's the performance, what's the volatility, because a lot of that is math. It's really about setting expectations. One of the things that I talked about on an all-hands call with my client-facing advisors yesterday was just this idea of, look, we're 6 weeks into this. The average bear market throughout history is about 13 months. So you have some that are 8 months, which would be what Shannon's talking about, and I hope that ends up being the case, but some that are 2 years. And we really don't know at the outset the depth and the duration. Now, you could make the case that a lot of the stock decline that you typically see in a bear market, we've already had it. And that's reasonable. So I think what we're trying to do with clients is to have them be prepared for a more worst-case scenario. And we've got tools in order to counteract that. We manage money both strategically and tactically. So that's not really the big concern. The big concern is duration. Because as excited as people were to buy the dip, understanding all the terrible news that's happening on the health front, as excited as people were to buy the dip, will they have the same enthusiasm to do that, Scott, if this is still going on in June or in July?
I even wonder,
my take from 20 years of experience is that they won't.
Let me read you some of the, I read you the headline of the Morgan Stanley note, and now let me read you some of the text because, if you if you subscribe to this point of view, it changes the way you're going to think about the stock market. We now see a shallower rebound in Q3, and we do not see activity returning to its pre-virus level until the end of 2021. So that's a long way off.
Can I just point out something that happened this week? So I think what happened this week was really constructive for the bulls, and I'll explain to you why. Last week we had an amazing rally, a historic rally took place, and that's great. It gives people a chance to relook at their allocation and catch their breath and make decisions without an explosion going on in front of them on the screen. So I like that happened. And this week we really didn't give that much back. So that's constructive. Secondly, there is a differentiation in what got hit this week. It was not across the board. So this week, the hardest hit areas, retail. So take a look at the XRT and REITs, IYR, anything to do with property. That actually makes sense to me. And then, of course, Carnival down another 40-something% this week. So, there's still pain for the airlines, for the cruise lines. And now they're hitting the names that are most susceptible to this drop in consumer confidence. It's rational. It makes sense that that's happening. But then Amazon is up on the week. Microsoft is up on the week. These companies have almost become infrastructure plays. They're how we're getting by right now. So I like, Scott, that there's dispersion and that we're making a judgment call before we just sell everything. That's what's changed this week versus 2 weeks ago.
Well, what about the notion, Jim, that Chanos told us yesterday, warning against piling into those so-called virus stocks, whether it's the Zoom or the Peloton, Teladoc, the names that have been thrown out as the ones who are going to thrive, so to speak, in this sort of environment where, things are different and the work from home thing may go on longer. Being at home may go on for a little bit longer. So Josh talked about a group of stocks that have been, hit. Some of them are in the eye of the storm here. Then there's others that have done better. I wonder if you need to just reassess sort of where everything is at the current time.
Well, certainly. And, we're getting a lot of client inquiries on those stocks. And when you look at the balance sheets, when you look at the cash flows of a Zoom and a Peloton, what it tells you is that they're very healthy from a financial point of view. But what it doesn't tell you is what sort of valuation you should put on these stocks, not in the current market environment and not with the volatility that you've got. So what I've been saying to clients who talk about Zoom, Peloton, or even in Abbott Labs is, look, these companies are fine for the long run, but you should expect the volatility, perhaps a little bit less than the market overall, but you should expect volatility in these names because there's no way to properly value them. You can't really do an earnings model, even with these so-called darlings of the stock market. And I think that's a way of saying that at the end of the day, a stock is a stock. And if we had a bear market rally last week, which is what it looks like, and if it looks like we're going to retest the lows, even the darlings will go along for the ride. But those names are likely to be muted on the downside.
But are we wise?
Hey, Scott.
Hold on a second. I want to ask you a question, and you can answer it however you want. It seems to me that the conversation is around where we started it, with the Morgan Stanley note as the narrative of you're either thinking this is a 2-quarter deal, or you're thinking it's a 6-quarter deal, or somewhere in between. And the somewhere in between, and wherever you fall in that spectrum, tells a lot where the stock market may be by virtue of what the reality turns out to be.
I think that's absolutely right. And I don't believe it's a 2-quarter phenomenon. I believe it could be a 2-quarter phenomenon for a lot of public companies if you take those measures that I mentioned before. But here's why it's not, because people are going to be upside down. I looked at some statistics yesterday. 75% of the U.S. population lives paycheck to paycheck. Once those full paychecks stop coming in, then the bills start piling up. So we're an economy where 70% of GDP is driven by consumer spending, by service companies. those service companies aren't going to see their revenues hit the prior peak for a long time because people are going to be worried about paying rent, putting food on the table. So I don't see any way we come back in 2 quarters.
Well, not only that, it's like on the other side of it, once you have to deal with all those issues that you brought up, it's the apprehension to even get back to the prior level of normalcy. It's being in a crowded restaurant, hotel, or airplane, or any number of other things that we could mention.
After 9/11, it took 3 years for airline traffic to come back for passengers. And there you could see that security precautions were really strengthened. And arguably, it was much safer to fly at that point from the security standpoint than any point before. But 3 years it took to come back. I surmise it'll take, I don't know if it's 3 years, but it's not going to be 6 months or a year to come back. And that leads me to the comments that Jim made. Peloton, hardly people are piling into it. The stock's not back at its highs. So I think it's rational. And if you call the company, they've got a tremendous backlog. So being consistent with that theme, people are going to change their habits from going to a gym, which is not cheap, to buying Peloton. However, when you take a look at Zoom and Teladoc, and I've been saying this for a while, as irrational it was to go out and sell stocks just without any forethought, it was the same irrationality that caused people to buy Zoom and buy Teladoc. Now, they're good models, but Zoom didn't deserve a market cap of $40 billion or even $34 billion now, not when there are so many competitors there. So you have two sides to the coin as to what's a rational behavior in this market. And I agree with Jim on that front, but not for Peloton.
Let me bring in Mike Santoli, who's joining us today, our senior markets commentator. It's been a while since we've had Mike on the show. We're glad to have him back. So, you can take stock of the week. You can weigh in on this Morgan Stanley thing too, and how you believe that shapes your own view on where you think we may be going.
Sure. Look, I think everyone's getting at the point that it's the duration that matters a lot more. We can make the argument that a 30% drop in the S&P that not only went down 30% in a month, but took the index back to where it was 3 years earlier. I think that's the other thing to keep in mind. We're talking about when do we get back to last year's level of activity? Well, we're at a stock market that's at 2017 levels. But I think we have to get away from this idea that the markets collectively are trying to sniff out some objective reality that sits a few months out in time. There isn't one. It's not known and it's not knowable. So with all that being the case and the market being open every day, it's going to be impatient. It's going to price in a good scenario some days. It's going to price in a dire one the next day. And I think that the reason duration matters so much is that that's when the clock is ticking on the solvency of large parts of the economy. So the credit markets are the ones that are going to kind of be on the front lines of trying to figure out exactly where we are in terms of the erosion of the creditworthiness and the rise in default rates and things like that in large parts of the economy. So that's why I think the stock market has traded right along with credit this week. I don't want to get into who's leading, who's lagging, which market's smarter, which one's not. But in the absence of economic data that is relevant in the moment, we don't have a critical mass of crisis-relevant data right now. I think this is how the markets are trading. So, I try to keep a couple of different independent scenarios in mind, which was the low from a week ago Monday looked pretty decisive in a lot of respects in terms of how washed out the market was, how violently it came back on a reflex basis, and maybe that did price in at least the depth of what we're facing in the shock. But the rally itself didn't really prove all that much. I agree with Josh that it's bullish to go kind of sideways and just kind of, sag a little bit this week in terms of the S&P, but it doesn't necessarily tell you that it really gave anybody impetus to say, I see how the comeback looks. And that's what we're fixated on.
But do you think then, are you suggesting that we're going to be in potentially a range of some sort until we get more clarity that the violent moves up or down are maybe in the near past and for a while, and it's just going to be this, up 500, down 400, up 500, down 400?
I think a range makes sense. I mean, now that everybody has sort of adapted to the idea that things are bad, they're going to stay bad for a while. We really don't have clarity on exactly what the criteria are even for when things reopen and restart. So I don't think a range would be a bad thing. One element I think is probably going to become front and center too, though, is what Congress has done. Is it enough? Most people say it's probably not enough if this lasts a while. So then we're going to be trading headlines on the next package. Is it going to happen? Is there urgency for it? Is there political will for it? So I think a lot of things can come in to disturb this idea that, we're just going to sit around these levels. Because as I said, the market is fundamentally impatient when it comes to the day-to-day. And it's going to get kind of bored and annoyed with this. And it's, again, going to have these sort of false starts and over-anticipate good and bad scenarios. One thing to keep in mind is the stuff that has continued to lead and work, right? The large growth stocks, the NASDAQ 100 type names, you really have not gotten hurt if you were long that stuff against the rest of the world. And it's worth asking the question if that scenario can persist if this goes on for a while. In other words, can you actually have a place to hide in an environment like this that manages to work for a very long time? I don't know what the answer to that is. I see all the reasons in the world why those companies should do better than the rest, but it's worth asking if that's something that just becomes a matter of fatigue and it doesn't have the buying energy to keep these valuations intact. Josh?
Yeah, I would just, to Michael's point about, where to hide, it is very clear when you look at cap size. Small caps this week are down 6.7%. If you go by the IWM ETF, the S&P is down 1.7%. There is a clear preference for well-funded, large enterprises over small caps. And that's like intuitive, right? Because which companies are going to have an easier time financing themselves and which companies will have a tougher time. I wanted to ask Mike, though, somebody said something very interesting to me, which is that how you're thinking about the timetable and how bad things will get might be a regional phenomenon. And a lot of money is managed in New York, Boston, and Chicago, where obviously the death rates are higher, the infection counts are higher. Everything just seems more severe. On the West Coast, they seem to have done a much better job flattening the curve. And you might have a disparity out there amongst even professional investors based on a bias concerning what the health situation feels like around where they live.
Right.
Santoli, are you hearing anything like that out there?
It makes sense to me, but I wonder how exactly to sort of project ahead what that might mean. Does it mean that because...
Well, it might mean a preference for tech stocks.
Well, okay, but I was going to say, is New York centrism going to mean that when New York looks like it's peaked and rolled over, that everyone kind of thinks it's an all clear, whereas the rest of the country is still behind us, and the global effects have not really worked their way through? So I think it's worth thinking about those things right now. But as you say, though, it makes sense, these companies that have held up better. But is it always the intuitive thing that continues to work as we go on in time, and there's kind of wear and tear of reality versus expectation?
Jim, are we all in agreement on the panel that the virus numbers supersede the economic numbers, Jim? That we know the economic numbers are going to be dreadful, and they're going to be dreadful for a while. The virus numbers are the ones that are going to have a greater tendency, perhaps, to actually move stocks, to make us feel better in the big picture, to give us some sort of idea of a date specific, if not hope, of when we can get back to work.
Scott, you went to the root cause of the disaster here. So the short answer is yes, that's what matters. And, if you think about that further and you think about what the medical profession is saying, we have at least 2 weeks before any sign of clarity comes. I mean, any slight green shoot of clarity on when this contagion ends and the economic shutdown with it. 2 weeks. I mean, that's going to feel like 2 years. Every day feels like a week already. The problem with that is there's not going to be any information, whether it's economic or earnings, that will give us any insight into what the other side of this looks like. That's what the problem is. I'm not negative in the long run, all right? I do have an inclination, shall we call it, that we're going to retest the lows, and it's specifically because the stock market hates uncertainty, and you've got at least 2 weeks of maximum uncertainty. It's just not going to ebb.
Right, there is no other side until the virus numbers get better. I mean, that's just the way.
I mean, it's that simple.
Is it that simple, Shannon, right? Why bother thinking about what the other side is going to look like until we get the virus under control, until the spread starts to slow down, and still the death rate in some of these hot spots around the country slows, flattens, starts to go down, whatever?
Well, I think that's why there's no point in trying to bottom fish here. I think Mike made a great point about the types of companies that are performing well. This is the same quality bias that we've seen over the course of the last year. And based on historical numbers that we've looked at, when the VIX moves 2 standard deviations, quality outperforms in those periods afterwards. So, whether you're working with individual investors or you're more of an institutional investor, it doesn't make sense here to bottom fish. And so until we get more clarity on the virus, I think any buying, apart from what you're seeing in the energy market, which is obviously just stabilization based on exogenous price changes, I don't see a lot of impetus for us to try to look outside of that boat of stocks that's held up pretty well over the course of the last couple of years.
Weiss, right? I mean, we're talking about, I'll just go back to how you started things. We're talking about companies, quote unquote, doing the right thing. And I totally hear what you're saying, and I think it totally matters. And it will matter forever. Maybe the companies that stepped up, so to speak, and did the right thing now, they'll be viewed differently than ones that are viewed to have not done that. Do you agree, though, with this idea of it's hard to think about the other side until you, even from a stock market standpoint, of dealing with the virus numbers?
I agree 1,000%, and that is the absolute delta. And to me, it's got more of a geometric effect. So in other words, it's not 2 plus 3 equal 5. It's 2 times 3 equals 6. So the more we get into the hole in terms of the numbers, the more we're going to get into the hole in the economy, and the greater the fear factor is. So until we get clarity, and I'm not so sure that we absolutely have to see the other side, because the market's a discounting mechanism and it discounts things that we don't even know why it's discounting or when it will. But my suspicion is before we peak, before the numbers are the absolute worst, that we'll have seen so much carnage, so many terrible things on the news every single night throughout the day that the market will get past it. But then we'll revisit what it means economically to the economy. So neither is a good picture. To Mike Santoli's point that we're back to 2017 levels, let's not forget that the market did nothing for 18 months until that last spurt in 2019. So the market was already just wallowing in an area where it needed multiple expansion to move forward. So we're going back to that, and then we're going worse. So I don't think, to Shannon's point, that now's the appropriate time. But what's kind of interesting here, and my last thought, and I'll go back to you, is that what's interesting is that I have a high beta portfolio, and that high beta portfolio is generally a double-edged sword. In good times, when the company is performing, it does well. In bad times, it exacerbates the downside. Despite heightened volatility, albeit coming down over the last week, that portfolio is acting like a champ, because they are the quality growth companies, but you're losing the valuation umbrella of the entire market. So no, I don't think they hold their levels where they are.
Well, here's the problem, Shannon. You guys, not we, you guys who are managing money and who are giving people advice on money are doing it theoretically because you think you have some level of clarity on where things are going to be in a few months, 6 months, however many months in the future, right? You're predicting, making a prognostication on where you think and a probability of where earnings are going to be. Here, the new normal, perhaps for an investor, which makes it extraordinarily different and difficult, is that you have no clarity on anything. You have no clarity on when the virus is going to level out, and you have absolutely no clarity on what the other side, so to speak, is going to look like. So, good luck.
It's very challenging. If you look at the three-legged stool, we had fiscal stimulus and monetary stimulus. That's great. They're the backdrop for what is next. And a combination of better data on the virus, and you've seen the story, Scott, about different apps that are going to be utilized to track ways that people can self-report, along with economic data. And the challenge here, again, I talked about this. There's a lot of things being said about when jobless claims peak. These periods where it's 6 weeks or 8 weeks prior to we start to see the turn in the market. I think you're right. I think that it's impossible to use those comparisons. I think that we can use some historical context as it relates to when we've had significant declines in consumer spending, when we have seen a significant number of low-wage job losses, and where the economic impact was in those particular scenarios to help guide us But you kind of look at what happened previously. I agree with, I think it was Josh who said, I don't think we get back to, the level of economic activity from a consumer side in the third quarter of this year. But how much of that have we priced in? And if we get back to 60% or 70% of that activity by the second quarter of next year, are there firms, are there companies that you still think that you can own where you can look at the sales and revenue that they had over the last couple of years and extrapolate that with a discount? And it's challenging, and that's why there's no absolutes with these clients. So
yeah, I mean, Josh, lastly to you, just feel like you can make a plausible case if you're an investor today that I think stocks have come down enough, and if my time frame is 3 years, 5 years, or longer than that, you can make a quality and credible case that stocks are attractive, right? I mean, we certainly hope that a few years from now that the market looks a lot different than it does today. It's going to be really difficult to call bottoms or call this or that for 3, 6, 9, 12, 18 months or whatever. But if you are a long-term investor, and we've had people come on this show who aren't buying for tomorrow or the day after, who've made what I feel like are credible cases for the longer term, depending what your age is and what your time horizon might be.
Well, that's the whole point, right? So I'm 43 years old. I fully expect to see Dow 100,000 in my lifetime, and that would not be outrageous. That would be a compound annual rate of return of about 7% for the next few decades. So, of course, that's the way I'm thinking about it, because I'm not 2 years from retirement, in which case, if I were fully invested in equities, I would be terrified right now because I've lost years of working that I can't replace. I can't do what I did in my 50s and 60s to reaccumulate those assets. So, of course, the answer to that question always depends on the audience. But I would throw out two things to you. The range of possibilities has broadened to the point where we should be worried about this idea that we do have a recovery, even if it starts later this year, which would be great. And employers realize, you know what? I actually could get by with just 80% of the staff I once had. Turns out, I don't need everyone back. That kind of thing represents a structural challenge to the labor pool, which then obviously affects the consumer and the multiples we pay for stocks and go on down the chain. That's a potential structural bearish thing that we have to think about. But then that's balanced out with this idea. We don't know what the catalyst will be, but there is potentially a 10 or 15% 1 or 2 day face-whipping rally out there predicated on could be any of the following. The FDA approves a treatment, whether it's hydroxychloroquine or something else. I'm not from the medical realm, but we get an approved treatment that is proven to get people off of ventilators or keep them from being on. That headline could give you 1,000, 1,500 Dow points immediately. It could be a gap open.
I agree with that.
A headline like New York peaking. If New York State's now 4,000 cases a day, which is not great, obviously. If all of a sudden we start to see that peak, people are going to buy stocks because I think Weiss said this before. It's going to represent a light at the end of the tunnel that we don't have right now.
That's exactly
right. We don't even have it in Europe. That's going to be one of the biggest rallies of your lifetime.
I agree with you on that. I feel like that's the toughest part about this whole story, whether you're anybody out there not even interested in the stock market or people who are investors. There is no light at the end of the tunnel at this point. You can't see it. The whole thing looks dark. So it's hard to have a positive feeling about anything. Any ray of light would be a huge help. I couldn't agree with you more. Let me go to Frank Holland real quick for a market flash on FedEx. Hey, Frank.
Scott, FedEx at session lows down more than 6.5% after the company cut the pay of founder and CEO Fred Smith and drew $1.5 billion from its credit line. At Smith's request, the company lowered his pay by 91% for the 6 months between April 1st and September 30th. FedEx also withdrawing its full-year guidance due to the COVID-19 pandemic just over a week ago. March, Smith told news outlets he did not believe that FedEx would need government aid or need to lay off workers. In today's filing, they said government aid could now be a possibility. Again, FedEx shares falling more than 6.5%. Back over to you.
Yeah, appreciate that, Frank. Thank you so much. That's Frank Holland. Let's go through some of the moves that you guys are making. That was a good break, in fact, to get back to doing that. Steve Weiss, what are you doing in the market?
I'm not really doing much. The only thing I've done of note is that I went back to Lulu and I sold calls against it. So it got me in $6 cheaper. But then I got stopped out quickly, so covered the call. So look, I made some moves. I did actually add a little to Microsoft, but I had sold some. Facebook. I bought Facebook, and then I got stopped out of that over position in Facebook. So I'm doing nothing now. I'm looking for that fat pitch where you have true momentum in the market. I know I can make money on the short side. Anybody can. But I just think there's something wrong with shorting stocks in this environment. So at this point, I'm sitting in my hands. I'm comfortable with my equity exposure. I expect to test the lows. At that point, I'll decide if I want to put more money in the market. But it's very difficult in this environment, as you highlighted before, where you get no respite from negativity. You can get it looking at a portfolio when you go home, spend time with your family, you go to a restaurant, you go to a movie. You don't have any of that respite. So it's very difficult managing that negative outlook.
You know what the other thing is that as you look, we talk to Dr. Gottlieb every night on our 7 p.m. special, and he is about as resolute as one can be in a sea of uncertainty, if that even makes any sense whatsoever, that you're going to have by the summer some sort of therapeutic available. So the closer you get to the summer months, the more difficult it may be to be more negative on the market, because you do risk being on the wrong side of a Josh Brown-like headline of what he said that turns bearishness on its head. That's one of the issues I think you have to deal with, too.
Yeah, I was actually emailing with a great friend of the show, phenomenal investor, Jeff Gunlock, yesterday, the day before. And yeah, that's the risk to being too negative. That's the risk to be short, in addition to the anxiety of being short. And I think that ultimately happens at therapeutic before a vaccine. So Josh makes an excellent point, and I'd love to see it happen. I'd love to miss the rally because that happened.
Yeah, everybody else would too. We're going to take a quick break. Another volatile week of trading. Investors weighing the worst jobs report since 2009. Former Dallas Fed President Richard Fisher is with us on the other side when the half comes back in just 2 minutes.
Did you know TuneIn doesn't just live here on your smart speaker? From the audio that moves you to the audio that gets you moving. Soundtrack your every movement with the free TuneIn app. Available on your phone or tablet. Download TuneIn on the App Store today.
Keep up with everything happening in the wild world of pro wrestling with a TuneIn podcast. For expert analysis straight from the WWE to Steve Austin's no-holds-barred conversations with wrestling's biggest personalities, search sports and scroll down to the world of wrestling to listen.
Did you know TuneIn doesn't just live here on your smart speaker? From the audio that moves you to the audio that gets you moving. Soundtrack your every movement with the free TuneIn app. Available on your phone or tablet. Download TuneIn from the App Store today.
Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow @TuneIn and always be in the know.
Behind the highlight reels, championship rings, and colossal paychecks, there are sports stories that fuel, deepen, and even challenge our love for the game. For true tales of underdogs, anti-heroes, and game-changing innovators, explore a sports documentary on TuneIn, like Sports Wars, telling the origin stories of classic rivalries, Raise Sports, about the concussion crisis that threatens football's future, and Dunkumentaries, a podcast devoted to the beauty and power of the slam dunk. For these and more, search sports documentaries on TuneIn.
Stressing you out? Take control. A personal loan could help you crush high interest rates and reduce your monthly payments so you can get out of debt faster and save money. Whether you're a credit stud or a credit starter, at Credible.com, we help you find great rates from multiple lenders. In 3 minutes, get actual pre-qualified rates. Have the money you need as quickly as tomorrow and start living your life.
Visit Credible.com to see how much you could save.
Hi, I'm Hanno. I created Gabi because most people overpay on car insurance. Gabi is a free tool that saves you money by finding the best deal. Gabi users save more than $800 per year on average. Go to Gabi.com and stop overpaying for car insurance.
We are KiwiCo, and we deliver hands-on STEM projects designed to inspire young innovators. Kids of all ages can explore science, engineering, art, and more. Get your first month free. Visit trykiwico.com.
to our Frank Holland. He has the headlines for us. Hi, Frank.
Hey there, Scott. Here's the very latest. New York Governor Andrew Cuomo is reporting 562 new deaths from the coronavirus since just yesterday. It's the state's deadliest day yet. To limit casualties, Cuomo is authorizing the National Guard to seize unused ventilators and protective equipment from private hospitals and companies in the state and then distribute those items to New York City. Cuomo also welcomed assistance from all across the country, and he promised New York will be the favor.
When our curve is over, that's what we're going to do. New Yorkers are going to take what we've amassed. We're going to take our equipment. We're going to take our personnel. We're going to take our knowledge, and we will go to any community that needs help.
Now looking at Europe, Spain is reporting its first decline in daily deaths in more than a week. Spain remains under lockdown as police enforce traffic controls that are leaving Madrid streets deserted. And birthdays in the age of social distancing, they can still be special. Albuquerque police pulled out all the stops when they heard Zach Jimenez was turning 4 and he loves police cars. They sent police cars, motorcycles, and even horses by his house, and even sent a bomb robot to deliver a present to this young man who has a disease called spinal muscular atrophy. And if you look there, you see his smile. I think that pretty much says it all. As always, for more coronavirus coverage, head to CNBC.com. Back to you, Scott.
All right, we appreciate that, Frank. Thank you. Well, today's terrible jobs report only underscores how challenging the economy is going to be in the weeks and perhaps months ahead. It also means policymakers are going to be on high alert continually. Richard Fisher ran the Dallas Fed from 2005 to 2015, joins us now. Richard, welcome back. It's nice to see you. I hope you're well.
I am, and by the way, you're doing a great service. Your show has really become enormously popular for a reason, because you're giving out some good information, and I appreciate it.
We're grateful for you to say that. Thank you. So let's take the jobs report and look at it in the. Can you hear me? You know what? We'll try. Richard, can you hear me?
I think we're back on.
Okay. First and foremost, I said.
It's not clear exactly how that's going to work, how much access people have, even though B of A and others have put up their lines. And you're going to be a little bit wary, if you're a worker, of going back into a high-density workforce in particular. That means bars, restaurants, transportation, sporting events, all those kind of things. That adds to 20% of our economy. That's a fifth of our output is in those spheres. And you're going to want protection. And if you're an employer, you're going to want to be able to construct yourself, reconfigure yourself to space things out. So I'm not of the school that we're going to have a V-shaped recovery. I believe it's going to be a prolonged U, and it's going to take time to work our way out of this situation.
And what policymakers have done to this point and what they can still do.
Right.
Have they done a good job in your mind? They've certainly done a lot. And what more can they pull out of the toolbox if necessary?
Well, first of all, the nice thing is we had the playbook at the Fed that when I was there, developed by Ben Bernanke and our team, we could pull that out pretty quickly. So they were able to do it off schedule, as you saw. And these are the kind of backstop programs we did in 2008, 2009 for a different reason, the collapse in counterparty trust. So money market funds, commercial paper, bonds, et cetera. We made every one of those markets. We retired those programs when they were done. It took us longer to undo the trust for AIG, but we brought them to a halt after they had done their magic. That is separate from expanding the balance sheet and the rate cuts that are taking rates to zero. I think it's important to bear that in mind. Now, additional tools have been added here. The Congress has provided some fiscal backstop, particularly for the lending programs to business. The numbers are huge. If you net out the so-called strategic industries like Boeing and so on, there's about $4.5 trillion that the Fed could leverage from the $450 billion provided by Congress. That's a pretty big number, but at the same time, when you take all the bond issuance that took place in 2019 amongst those that go to the bond markets, and all the C&I lending on the books of banks at the end of last year, that number gets swamped. It's about equal. And it's a question, again, of how long this goes on. And already you saw Nancy Pelosi this morning on CNBC saying she wanted to do more. And we're just going to have to see whether or not this does the trick. It depends on how quickly you think things are going to recover. And I'm rather pessimistic that it can be a quick recovery.
So I'm just wondering if you can put us in the room and what you think Mr. Powell is thinking today, knowing that he may very well be faced with what the investor is faced with in what may be his new normal of no clarity on virus and no clarity on other side. So how do they think about what the future is going to look like from an economic standpoint if they're looking through a glass of milk on both fronts?
Good question. The Fed is a deliberate institution. Again, we had a toolkit. They had a toolkit they could draw because we developed it the last time, and they threw it out there very quickly. Right now, I'm sure they're just it's a natural Fed tendency to see if something's going to work. I'm going to say something I've said before to you and other folks on this network. I'm grateful that Powell is there. He has a credit market background. He understands the Treasury, having been Assistant Secretary, Undersecretary under George H.W. Bush. He knows how to work the Hill. These are talents that are coming to bear here that his predecessors, frankly, great guys, Ben Bernanke, great woman, Janet Yellen, did not have. But you always want to be cautious when you're at the Fed and you want to see how things are working. For example, the Main Street lending program is going to be pushed out and overseen by the regional banks, like the Dallas Fed, all the other 11 Federal Reserve banks in addition to that one, so the 12 banks. I think they're still trying to figure out how the heck they're going to do this. And what do they do in terms of forbearance or supervision, regulation? This is still being worked on. And until you have a sense that you can administer this correctly, you're going to take your time. Obviously, they can't cut rates further. Negative interest rates are out of the question. They've made that clear. You can't expand the balance sheet. If you look at the balance sheet yesterday, it's pushing up towards $6 trillion. We're likely to see it go, as I've said before on this network, beyond 7, even before this crisis. So the urgent programs to backstop lending and to support employment that are going to be administered through the Fed, they're going to make sure that they actually can deliver and make those things work. And it's not clear right now whether or not that's been done.
Well, let me ask you this. You just used the words out of the question. You anticipated my next question, by the way. And you said negative rates are out of the question. Now, I know that the Fed chair probably doesn't want to go to negative rates. But what happens if rates get away from the Fed chair himself? I mean, rates are already moving lower. What if we just go down towards negative rates?
Well, we did see the 1 and 3 month trade negative for a brief period about a week ago, right? So I'm of the school that believes the Federal Reserve has lost control of the yield curve. You can't say that the Fed pushed the 10-year down almost 2 weeks ago to below 30 basis points. I was in Australia at the time. I was meeting with the 2 big banks there and the large companies, the miners and Qantas CEO and others. They were hoarding dollars. They were doing everything they could to get into treasuries. And that, I think, is what a small microcosm in a very big market, but they're not insignificant, tells you that the market determines these rates. I believe the Fed has lost control of the yield curve. The only thing they have is the low fulcrum point, and the markets don't respect that as much as they used to. Mm-hmm. So the 2, the 5-year, the 10-year, these are determined, and the 7-year, these are determined by market forces, and they could indeed, since there is a enormous premium being placed on dollars right now, they could indeed push these yields much lower. The negative side of that is it sends a signal to a congressperson, I can spend still more, because the cost to carry is less.
Mm-hmm. Richard, we appreciate it as always. Thank you for being here, and I sincerely appreciate it. Yeah, you be well. You take care of yourself and your family.
Bye-bye.
Okay, that's Richard Fisher. Up next, New England Patriot Brandon Copeland, a member of the CNBC Financial Wellness Council, is here. How he is helping his fellow NFL players during the virus outbreak. That's straight ahead on The Half.
It's Tune In Sports on this day, March 27th, 1988. The Chicago Bulls and Atlanta Hawks match up in the Georgia Dome in Atlanta. Now it draws a crowd of 62,046, the largest in any game in the NBA history. And the Bulls win 89-74.
Well, there's no question the spotlight today will focus on Dominique. Given what happened last week, I would think there's some incentive for Dominique to
listen to conversations breaking down the moments just like this. Click on sports to be part of the discussion on TuneIn. Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow @TuneIn and always be in the know.
Did you know TuneIn doesn't just live here on your smart speaker? From the audio that moves you to the audio that gets you moving. Soundtrack your every movement with the free TuneIn app. Available on your phone or tablet. Download TuneIn from the App Store today.
Want to know a quick, easy way to see if your favorite podcasts have a new episode available? Just go to the home screen on your TuneIn app to see the latest editions under the Your New Episode section. Happy listening.
Not all heroes wear capes, but most wear tights.
And here we go. Now it's underway. Cover on Rowan. Wait a second.
Keep up with everything happening in the wild world of pro wrestling with a TuneIn podcast. For expert analysis of the latest WrestleMania, turn on the WWE podcast. Or listen to the Steve Austin Show for no-holds-barred conversations with wrestling's biggest personalities.
It's good to be here tonight. It's an empty building.
For these and more, search sports and scroll down to the world of wrestling.
Keep America strong. Thank you.
Welcome back. CNBC has partnered with Acorns, the saving and investing app on a financial wellness and education initiative called Invest in You. Ready, set, grow. And that brings us to an NFL star who is using his downtime during the virus outbreak to offer financial advice to his fellow players. Brandon Copeland is a member of CNBC's Financial Wellness Council. He is back with us today via Skype. He, by the way, recently signed with the New England Patriots. Brandon, welcome back. It's good to see you.
Thanks, Scott. How you doing?
I'm doing well. I'm trying to hang in there. I hope you're well and you're safe and you're feeling healthy too.
Yes, sir. Thank you so much.
So like many professors, you've gone to the virtual classroom to continue to do what you do. Tell us about it. I thought this is an interesting thing you're trying to do while you and your fellow players in the NFL are waiting to see what happens with the season.
Yeah, fortunately, I mean, with the University of Pennsylvania, we had to make all of our classes remote anyway. So by being able to use this as an opportunity to also have a chance to reach out to my fellow players, I know exactly where they are, shouldn't be leaving the house for the most part. So, it's an opportunity to help everyone understand that we can utilize this time to build ourselves so that, God willing, we all come out of this sprinting forward with a clear plan and a clear vision for ourselves and our future.
Can you give me an idea of how many players have taken part in what you're doing and how many of these you're going to do going forward?
Yeah, so we have 5 slated. We just had the first one on this past Tuesday. We had a little over 60 players join. Looking forward to having more join this week. Everyone's tasked with bringing a friend. Had great feedback and all of that type of stuff. And I'm looking forward to it. Have conversations with players who, without forming this group, I wouldn't have had contact with, so to speak. So, I think it's also a great way to connect us all across the country.
Have you felt, and maybe this is just yourself or what you've heard from your fellow players, about a change perhaps in the way that they view their finances in light of this crisis, which is not just a health crisis, it is a financial crisis and an economic crisis all wrapped up into one?
Yeah, I think it's a humbling experience for all of us, right? I mean, when you player, athlete, millionaire, non-millionaire, regardless, I think, you see how quickly things can change. And so I think, as people have always, I always say, you work as hard as possible to ensure that your next check grows. However, you prepare as if this is your last check. And so, I think this is a chance for people to get their affairs in order and understand that, this is out of everyone's control, right? No one has their control on this, and it's affecting us all. And so what can we do to make sure that we're in a better situation if something like this ever happens again, God forbid?
Yeah. I mean, maybe most importantly, how do you go from the Jets to the Patriots? What is up with that?
Business decisions, personal finance, right? It's business decisions.
Yeah. I know you're touched by what the Crafts did regarding the supplies where they sent their plane.
It's amazing. It's amazing. It's amazing to be a part of an organization that, is selfless like that. I think that my foundation and I, we've been thinking of ways to help, but to see that the Patriots organization utilizing their jet to go get these masks from China, bring them to the U.S. and just to help people. I mean, it's something special to be a part of again. It just makes me proud.
Yeah, no Tom Brady though.
Yeah, no Tom Brady, but I can play quarterback a little bit too. No, it's not.
Right.
No.
We wish you well. We're proud of what you're doing, trying to educate your fellow NFL stars through all of this, and we wish you the best and hope to see you on the other side of all of this.
Sounds good. Likewise. Stay safe. Thank you.
All right. You take care. That's Brandon Copeland joining us there. For more on Invest in You, go to cnbc.com/invest in you. One more time, cnbc.com/invest in you. And I also want to note that NBC Universal and Comcast Ventures are investors in Acorns. Coming up, final thoughts straight ahead.
Did you know TuneIn doesn't just live here on your smart speaker? From the audio that moves you to the audio that gets you moving, soundtrack your every movement with the free TuneIn app. Available on your phone or tablet. Download TuneIn on the App Store today.
Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow @TuneIn and always be in the know.
Keep up with everything happening in the wild world of pro wrestling with the TuneIn podcast. For expert analysis straight from the WWE to Steve Austin's no-holds-barred conversations with wrestling's biggest personalities, search sports and scroll down to the world of wrestling to listen.
Did you know TuneIn doesn't just live here on your smart speaker? From the audio that moves you to the audio that gets you moving, soundtrack your every movement with the free TuneIn app. Available on your phone or tablet. Download TuneIn from the App Store today.
Behind the highlight reels, championship rings, and colossal paychecks, there are sports stories that fuel, deepen, and even challenge our love for the game. For true tales of underdogs, anti-heroes, and game-changing innovators, explore a sports documentary on TuneIn, like Sports Wars, telling the origin stories of classic rivalries, Raise Sports, about the concussion crisis that threatens football's future, and Dunkumentaries, a podcast devoted to the beauty and power of the slam dunk. For these and more, search sports documentaries on TuneIn.
We've helped tens of thousands of people save money by refinancing their student loans. In 3 minutes, we'll get you actual rates from multiple lenders. We could save you hundreds of dollars a month.
Visit Credible.com to see how much you could save.
I got things I want to do, but student loans were holding me back. Credible.com helped me save $600 a month with a great rate. Now I can go do what I want to do.
Visit Credible.com to see how much you could save on your student loans.
Hi, I'm Hanno. I created Gabi because most people overpay on car insurance. Gabi is a free tool that saves you money by finding the best deal. Gabi users save more than $800 per year on average. Go to Gabi.com and stop overpaying for car insurance.
Just always thought dog food is dog food. Didn't really piece together that dogs eat food. As soon as we brought the farmer's dog in, her skin was better. She was more active. If I can invest in her health and be proactive, I think it's worth it.
Visit betterforthem.com.
Did you know TuneIn doesn't just live here on your smart speaker? From the audio that moves you to the audio that gets you moving, soundtrack your every movement with the free TuneIn app. Available on your phone or tablet. Download TuneIn from the App Store today.
It's TuneIn Sports on this day, March 27th, 1988. The Chicago Bulls and Atlanta Hawks match up in the Georgia Dome in Atlanta. Now, it draws a crowd of 62,046. the largest in any game in the NBA history. And the Bulls win 89-74.
But there's no question the spotlight today will focus on Dominique. Given what happened last week, I would think there's some incentive for Dominique.
To listen to conversations breaking down the moments just like this, click on sports to be part of the discussion on TuneIn. Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow at TuneIn and always be in the know.
A lot of people aren't aware that TuneIn lets you listen to the same terrestrial stations that you pick up on your FM AM dial, except you can hear them from anywhere. To see all the stations broadcasting in your area, find the local radio section on the home screen. Keep it local with TuneIn.
Behind the highlight reels, championship rings, and colossal paychecks, there are sports stories that fuel, deepen, and even challenge our love for the game. For true tales of underdogs, anti-heroes, and game-changing innovators, explore a sports documentary on TuneIn, like Sports Wars, telling the origin stories of classic rivalries, Raise Sports, about the concussion crisis that threatens football's future, and Dunkumentaries, a podcast devoted to the beauty and power